And connect with the management of ELGi Equipments, which put out its earnings. It's been a pretty flattish quarter. Dr. Jairam Varadaraj, Managing Director, joins in to make more sense of the kind of numbers delivered. And thanks for joining in on ET Now. I believe that there's been a decline in the revenues from the air compressor segment that has led to your overall revenue picture declining. Can you just tell us what kind of numbers you've delivered on that front and tell us whether or not this is going to continue into the coming quarters, or can we see a revival going forward?
Thank you for inviting us over for your program. Well, at a number level, we have our sales are lower by 8% over the last year's same Q4. But if you look at Q3, we have grown by 12%. The lower sales of 8% over last year's Q4 is purely a sectoral kind of a bonus that we had in the last year's quarter. So nothing to be worried about in terms of sustaining fundamental growth on all the sustainable kind of product verticals. Compared to last year, we have grown, we have lower by 2%, but again, we had shut down certain subsidiaries or exited certain subsidiaries in France. So if you net that off, actually our growth has been in the range of about 4 to 5%. That's on the sales side. So overall, it looks reasonable. I wouldn't jump on top of the table and celebrate it, but it is indications of good things to come in the future.
Okay, and what about the margin picture? 10.7%. Yes, you've grown on a year-on-year basis. Can we see the margins continuing to remain in these double digits?
I don't see why the margins can't be sustained if we get the top line support as we expect this year to give us. This is sustainable, but one area of concern is for us is the commodity price. There's been an uptick. We got to wait and see at what levels they stabilize. It's a little too early to predict what will happen to steel, aluminium and copper. So that's an area of concern that we are watching very carefully.
You know, hi, this is Nayantara joining in from the Delhi studio. You had earlier said you intend to achieve debt-free status by FY18. Are you on track for that? What all have you done to make sure that you are debt-free by the end of this financial year?
No, we had actually projected that we will be debt-free by September of 2018. We are on track for that. There's been a substantial reduction in our debt this year, with business as usual and performance being relatively flat. Our current debt is about at around 150 crores. So we are quite confident at the current rate of cash generation and tight management of working capital. We are pretty confident by September 18 we will be debt-free for the current configuration of business.
Okay, I was just coming to that. That means for the current order book, whatever you're working on right now, I would imagine that the internal accruals, the cash generation is enough to take care of that. But if you were to get a bigger order book, wouldn't that impact your plans as far as debt-free, becoming debt-free goes?
No, we don't see that as an issue because we are not a big order book driven business. We are a book and bill kind of a business. So incremental requirement for working capital can be self-generated. We don't see an issue. What I meant by current configuration is we are looking at inorganic growth opportunities. When those materialize, then there would be a separate kind of a debt structure for that. So what I meant is the current configuration in terms of the makeup of the organization now.
Mr. Varadaraj, as to how the international operations have fared this quarter and what is the outlook?
Well, our international operations have had a mixed results. America and Europe have been relatively flat, but we have done pretty well in our Asia Pacific markets as well as the Middle Eastern market. The outlooks looks pretty positive. Europe is coming back. We expect to see some good results. U.S. operations, we had some initial setback that we have consolidated. We expect that to come back. We expect Asia Pacific to continue to grow strongly. Middle East is an area where we need to wait and see, because we are looking at what would be the dynamics of the oil pricing, because the economies there are driven strongly by that. But overall, considering the optimism in India and what I've described of the rest of the world, we look forward to 17, 18 with much higher optimism than we did 16, 17. But the caution for us in India is how GST is going to get rolled out and what will be the ramifications. We all would go through that adjustment phase, but we need to see in the short term what will be the impact of it. We are not able to predict that.
Okay, letting you go on that note. Thanks so much for joining in and giving us a view on how things have shaped up. Flat for the stock, but what's not flat